Excuse me. Good afternoon, everybody. How's everybody doing today? Happy Thursday, which is technically our Friday, I guess. How's everybody doing? Good afternoon, Justin and Mary Ellen. How are we doing? How's everybody's last couple days? Good afternoon. Good afternoon. All right. Okay. So, firstly, thank you everyone for being so understanding on Tuesday. I really appreciate that. Yeah, thank you. So today we are going to kind of pick up where we left off, kind of. And I'm wondering, did everyone? I'm going to put up a poll just to make this anonymous. Okay, so a quick little question here. I just want to get a feel for the room before we continue. Question is asking, it's actually more of a statement, a yes or no statement. I was able to watch the video posted to this week's learning materials, primarily about ratio analysis. Okay, and if you're just joining us, we have a question here. Just want to see how many people actually had an opportunity to watch that video from Tuesday. Yeah, there was a lot of information in there. And I'm hoping today that we can kind of practice as we progress. And to that point, I'm actually going to open up some of those financials again. Where are we here? That's where we are. Quarterly report. Download. Sure. Open. Okay, there we go. Okay. So some people still not answered the question just yet. 1, 2, 3, 4. Okay, so most of us did, and that's good. If you didn't, well, you might. As Vanessa had mentioned, there is quite a bit of information in there. We're going to go over a lot of it again today, just as a refresher for everybody, and we're going to practice it. But if you didn't watch the video from Tuesday, this may take some time to kind of settle, if you will. So if you haven't watched the video, please do, because it'll definitely help with your exam, like a lot. Okay, so in that video, we went through and explained a whole bunch of different ratios in ratio analysis. Some were about liquidity, some were about leverage and solvency, some were around profitability, efficiency, and things like that. We are going to talk about those today. We are going to calculate them and do some examples based again on Cara Foods 2017 quarterly report that's posted to this week's learning materials, or this class's learning materials. And then there's two other kinds of analysis that we're going to go over, which is trend analysis and then the vertical and horizontal. Okay. Before I continue, does anybody have any questions, comments, concerns before we continue? Oh, okay. And because I did end class early on Tuesday, and because some of this material can be difficult to digest, I'm going to hold an additional set of office hours. So next week we won't have class. Instead of class, I'll be here on Collaborate during our normally scheduled time to answer questions. So I'll be here just for office hours. Okay. And you good folks don't have class on Monday, do you? No class. Okay, so on Monday, I'm also going to hold an office hours here on Collaborate between 2:30 to 3:30. Okay, where again you can come in, you can ask some questions, things like that, right? So there'll be multiple opportunities next week to come and connect with me one-on-one if you have any questions, or you want to practice something and kind of run it by me. And then that way, I'm just here for as much support as possible. Okay, so if you haven't written that down, write that down just in case you are interested in coming. 2:30 to 3:30 on Monday. Marianne, we do have a major assignment due Tuesday/Wednesday for a research class. Okay. The office hours that I'm going to hold on Tuesday and Thursday, they're optional. None of these you have to come to. I understand. I understand there are different priorities, especially in the final week of the course. So these are all optional. Okay, you don't have to come to these if you choose to put your priority somewhere else. I just want to make sure that I'm just available for you if you have any questions around. Okay, yeah, absolutely, yeah, yeah. And you guys should. Don't you have a major project in marketing? You guys are taking marketing too, aren't you? Oh, okay, okay. Well, that's good then. At least the next week will be just those last two. So yeah, Monday between 2:30 and 3:30, I will be available here on Collaborate just in case you have any questions. I wanted to do it earlier, but I have class. I have a cost controls class from 12 till 2. And then Tuesday and Thursday, office hours from 1 till 4. All dates, all times are optional for you to attend. You don't have to. If you have a question, pop in, ask a question, and then if I've answered your question, you've got no more questions, then feel free to leave. Okay, so it's all optional, just for here to support. So where we left off, if I can find it, pretty sure that's where we left off. So the major types of analysis we're going to be talking about today. Yes, Vanessa, you can come to Blackboard Collaborate to ask me during those times. If you have a question outside of office hours, you can shoot me a message on Teams if you like. Okay. Otherwise, yeah, come to Blackboard Collaborate during those times, and I'll be here. So the types of analysis that we're going to be talking about today and practicing is one, a trend analysis. Then we're going to be talking about vertical and horizontal analysis, and then ratio analysis. The video I had posted to this class's learning materials was, the video anyway, was primarily focused around ratio analysis. You've all taken cost controls before, and in doing so, you've calculated a lot of cost percentages, and that's exactly what vertical and horizontal analyses are based on. So you have a good leg up there. And then the trend analysis, which might be a little new, but the calculation isn't too crazy, and you can really only do it with sales and profitability. So I don't think that'll be very sticky, but we do have a lot to get through, so I'm going to continue here. So a trend analysis is useful in predicting earnings for a business in the future. It's also useful to look at a trend, because that's what we do in a trend analysis, is we're looking We're looking at that trend, that change over time, if you will. For example, what kind of change over time would you like to see in sales? Would you like to see your sales going up or having an upward trend or a downward trend? What kind of trend would you want to see? What kind of trend would you want to see in your sales? Your sales trending upwards or your sales trending downwards? Upwards, exactly, Mary Ellen. More sales is good. Less sales is bad, right? We want to see sales trending upwards. So when we conduct a trend analysis, that's kind of something that we look for. We want to make sure the sales of a business, from an investor's point of view, are increasing. Okay. We can also look at the trends in profitability, but we would want to do a different kind of analysis for that. So what we're looking at with a trend analysis primarily is whether sales are going up or down over time. And it helps us understand, or how we understand a trend is usually through what we call a trend percentage, right? We can say that sales are going up 30% year over year, or our sales since last year, our sales have increased 10%, right? That 10 percentage shows that your sales has increased by that amount, right? And how we calculate that, or that trend percentage, or YOY, right here, stands for year over year. I'm going to type that in the chat. Year over year. And how we calculate that is by taking sales in year 2, okay, we subtract the sales in year 1, that, and then we divide by the sales in year 1, okay, and that gives us the trend percentage. Okay, so the little example I have here on the board on the slide is 33.33%. What this means is that from year 1 to year 2, your sales grew by 33%. Okay, you can use this to forecast sales in the future. As an investor, you like to see sales increasing or having a positive trend. This is also something you would expect to see in the future as an investor, right? We're not going to talk about the pest analysis or the any kind of marketing analysis, because you've already talked about that in marketing. So what we're going to do here is a bit of an example, right? So can everyone pull up the financials for Carat for 2017? Okay, and put a thumbs up in the chat when you've downloaded that off Blackboard and you have that up. Okay, I'm going to wait for a couple more people. Let's get the financials open. I'll give you a couple more minutes to open up that file. It's under class 11 and 12 in our weekly learning materials. And one more minute, everybody. 1, 2, 3, 4, 5, 6, 7. Okay. So what we're going to do here is practicing calculating the trend percentage for the total gross revenue, so the total sales for Cara Food. Okay, so we're going to calculate the trend percentage between 2016 and 2017. Now in the chat, and look at the financials first on the income statement. How much were sales, or sorry, total gross revenue in 2016? Someone type it in the chat for me. And remember, if you're having a hard time finding it, the Control F is fantastic in finding line items. So you hit Control F and then type in total gross revenue. It looks like Vanessa found it. Absolutely. Total gross revenue for 2016 was $463,000. Ryan as well, $274. Very good. Now, can somebody in the chat let us know what the total gross revenue for 2017 was? Exactly, Justin. $775,241. Absolutely. So this is what we're going to calculate our trend percentage based on. So I'm going to share a whiteboard now. Okay. And remember, the trend percentage is equal to year 2 minus year 1 divided by year 1. Okay, so in this case, it's 2017 minus 2016 divided by 2016's sales. So in this case, the sales for 2017 were $775,241. $241. 241. I messed up that whole not saying that number. The sales in 2017 were $775,241. The sales in 2016 was $463,274. Okay, and then we would divide by 2016 sales. So again, $463,274. So everybody with me now, put this in your calculator and tell me what the trend percentage is. Okay, I'll wait for a couple more responses. All right, really good. Yeah, 67%. So what this means is that between 2016 and 2017, Kara's sales grew 67%. So increased by 67%. Yes, exactly, Vanessa. Sales went up, and they went up by 67%. Now, if you're wondering, is there a benchmark for what trend should be, or what it how do we compare this and say whether it's good or bad? Well, firstly, this trend is positive. Okay, so this trend is above zero, or the percentage is above zero. So sales are increasing, okay, which is a good thing. So to Vanessa's point, sales are going up. And in this case, sales are going up by 67%. That's really high. There's no real benchmark here, but over 50% is quite high. Okay, so in this case, sales went up 67%. That is astronomical. And we would say that this is a good thing. Okay, so I'm going to. Okay. No, Vanessa, this isn't necessarily the before the pandemic. No, this is not the kind of year-over-year sales trend we would see. What you would want to look at is multiple years, right? So between 2016 and 2017, sales grew by 67%. You could also compare that 67% with the trend percentage from 2015 to 2016. So you really have to look at the previous information for the one business. Okay, but as an investor, potential investors, you good folks would want to see a positive trend percentage. Okay. So how does that feel? Easy, not easy, confusing, straightforward? Was the example helpful? Got one thumb. This is good. And good people, you're practicing as we're doing this. You all got the right answer, right? Thank you. Yes, it does. And you all got the right answer. So this is what we're expecting you to be doing on your final exam, or one thing you should be doing on your final exam. Okay. And we're using Kara's numbers to do it, right? Just a different year. So Is everyone good to continue? Can I change the screen? All right. So I'm going to put, I think that's the PowerPoint. This is the PDF. There we go. So now we're going to start to talk about a vertical and horizontal analysis. Okay, both deal with percentages again. Both deal with cost percentages. Okay, the vertical analysis, or it's more more accurately referenced as a vertical common size analysis, but you can just call it a vertical analysis. Compares all figures on a statement with the base figure from the same statement. Okay. For example, a cost percentage. A cost percentage is the cost divided by sales, right? That's what we see on vertical analysis, is those cost percentages, because we're referring to those costs relative to the sales on the income statement. It's a relative figure. Horizontal analysis, on the other hand, compares all figures on one financial statement with the same account on a different year. So it's comparing those cost percentages year over year. Okay, and I think the understanding of the difference between the two is best shown by an example. So here's an example of a vertical and horizontal analysis. You'll notice that each week here has the dollar amount of each account. So week 1, 2, and 3, we have our sales, we have our costs, and we have our profit before income tax. You'll also notice that we have included the cost and sales mix percentages, right? When you're doing a vertical analysis, okay, you're looking up and down the statement in the same week, okay? So you're calculating the cost percentages, okay? Based on the screen here, your food cost, what percentage was your food cost percentage? Yes, Catherine.
Sorry, just to clarify, Professor.
Yeah.
I'm just going to get, sorry, Vanessa's just saying. So I was wondering, for each of the columns, like I know, for instance, for week 1, week 2, week 3, I see the columns. So is that the cost? And then in the next column, you have the percentage.
Correct.
I'm just not clear kind of the role of each of these columns. Can you just clarify that again for me, please?
Yeah, absolutely. So for each week, I'm just going to take that down. For each week, there's 3 weeks worth of information here. We have 2 columns for each week. The first column for each week is the dollar value. So in week 1, our food sales were $5,569. And then the next column is the percentage. Okay, so in this case, our food sales were roughly 70% of our total sales, or our food sales were roughly 70% of our total sales. Everything below that are our cost percentages. So our food cost in week 1 had a dollar value of $1,789. But that doesn't really tell us a whole lot. So we look at the relative figure. In this case, we say our food cost was 32.12%, and that's our food cost percentage. So that's the difference between the 2 columns. The first column is the dollar value First column is the dollar value, and the second column is the percentage. Okay, so the difference really is absolute versus relative. The dollar value is the absolute value of the account, and the percentage is the value of that account relative to sales. Okay, and we have that for each week. So again, we've got week 1, we've got week 2, and we've got week 3. When we're doing a vertical analysis, we're looking at the cost percentages in each week. So we're looking at the cost percentage, let's say for our food cost, which was 32.12%. Okay, if our standard food cost was 35, or sorry, how would I say this? If your standard food cost was 30%, okay, so your food cost was supposed to be 30%, and in week 1, it was 32%, would you say this is good or bad? Vanessa, this is an example of a vertical analysis. Think of vertical as up and down, and then horizontal is across the weeks. So the question is, your food cost was supposed to be 30%, which is typically the industry average, but your food cost was 32%. Is this good or bad? It's bad, absolutely, because your cost was higher than it was supposed to be. Okay, but vertical analysis, exactly, but that's bad. However, there is a limitation to vertical analysis, is without knowing the standard costs or what costs should have been, it's hard to kind of say whether each cost percentage is good or bad. What is much more valuable to you is the horizontal analysis, where you compare the cost percentages over time. Okay, so in this example, you could compare the food cost from week 1, or the food cost percentage from week 1 to that of week 2. Okay, so what do you notice between 2 weeks, week 1 and week 2, for your food cost percentage? Is it going up or is it going down? Okay, so you notice that's going down. What do other people think? Between week 1 and week 2, is your food cost percentage going up or down? Okay, 2 people saying it's going down. What do the rest of you good people think? Up or down? Okay, more answers. Yeah, down, right? And just like we want to see sales going up, we want to see cost percentages going down. I'm going to write that. Okay, so if you're seeing year over year or week over week that your cost percentages are going down, this is a good thing. Yeah, if you averaged it out, it could come to be around 30%. But again, if we don't know, and that is kind of the industry average. However, if we don't know exactly what the costs should have been, then we can't necessarily make a judgment call. And in this case, I'm not sure if we could find the standard. Maybe that's a little thing we'll do near the end of class, is maybe try and find the standard. And then, yeah, so good job, everybody. Now, what about the food cost percentage? The food cost percentage from week 2 to week 3. Is it going up or is it going down? Yeah, there was a slight increase, or an increase of 0.03%. Not a big deal. Exactly, Vanessa. Not a big deal. Okay, yes, it did go up, but not by that much, right? Anything below 1%, you probably don't have to wake anybody up about. Okay, it doesn't really matter that much. But anything above 1%, you would want to start to pay attention to. And we just did that for our food cost. You can do that for every cost on the income statement. Okay. Another thing that you can look at is the profit percentage between weeks, right? For example, the profit percentage from week 1 to week 2 increased roughly by 0.8%. Okay, it did increase. Didn't increase by that much, but it did increase. On the other hand, between week 2 and week 3, it decreased. Right? So we would want to go and look at why. Right? So if I had to look at it here, look at the big differences. And it looks like it was maybe the beverage cost that caused the profitability to go down in week 3. So that's what you're doing, is you're comparing those cost percentages, or those line item percentages, week compared to another time period, right? And that's what you can do with financial statements. Okay, so can everybody, we know what the sales were, the gross sales for Cara Foods was in 2017, in 2017. Just going to bring this up again. Let's find me and put in the chat the cost of inventories sold for 2016 and 2017. What was the cost of inventories sold in 2016 and 2017? And then type it in the chat. Thank you, Mary Ellen. I'm just going to find. Okay, that's where it was. Okay, so we've got the cost information. So let's do a bit of a horizontal trend analysis here. Sorry, a horizontal analysis here. So I'm going to share a whiteboard. Okay. So in 2016, sales were, sorry, just let me look in the chat again. In 2016, sales were 463,274, and in 2017, sales were 775,241. Okay. The cost of inventory sold, so we'll call this cost of goods, in 2016 was 141,000, $839. And then in 2017, cost of goods sold was $300,105. So the cost percentage here is the sales, or sorry, the cost divided by the sales. So everybody in your calculator now, or the cost percentage, I should say, is always the cost divided by sales. So can everyone let me know the cost percentage for 2016 and 2017 for our cost of goods sold? So throw that in your calculator. Okay, Vanessa, I think you might have them reversed. It's the cost divided by the sales. So 141,839 divided by 463,274. And then over here in 2017, the cost was 300,105 divided by 775,241. No problem. So what was the cost percentage in 2016? It looks like Su Young has it. It was 30.6%. Actually, roughly 30%, yeah. And then Su Young and Mary Ellen got this one as well. They got the same thing. In 2017, the cost of percentage for our cost of goods sold was a whopping 38.7%, right? Big difference between those two percentages, right? So what are you noticing between 2016 and 2017? Is your cost of goods sold going up or is it going down? Okay, quite a few people saying up, and then yeah, absolutely. Excuse me. Your cost of goods sold has gone up between the 2 years substantially, from 30.6% to 38.7%. Right? Exactly, Vanessa. Huge jump in the number, right? Now, here's a piece of advice. Oh, sorry, before I continue to my weird piece of advice, is this good or bad? Your cost percentage for your cost of goods sold is going up drastically between 2016 and 2017. Bad, 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 bad. Yes, exactly. This is bad. This is quite bad, actually. Now, when you see something like this, right? You see your a particular cost jump up. Cost. Let me say that one more time. If you see a cost percentage increase drastically year over year, and you see a big difference between the numbers, go ask why. Okay. So why? Why did the costs, our cost go up drastically year over year? Okay. Obviously, this is not good, but there might be a reason for this, right? Because we calculated the sales trend before we did this, and the sales trend was great. They were going up, what, 67% year over year? Right? That's a good thing. But then we've gone and we've looked at our cost of goods sold percentage, and it's gone up as well. And costs going up is not a good thing. So we know the sales are good. The one thing we would want to look at is your cost of goods sold. Okay, and this is where you would just let me quickly look at this. This is where you would want to go and look at the notes in your financial statement, okay, and go figure out why this increased so drastically, right? So you'd hit Control Find, and then type in this case, I believe it's called cost of inventory sold. Okay, you would then go and search for any information on the cost of inventory sold that you could find that might explain this whopping increase to 38%. And again, because this is comparing the same line item and the line account over 2 periods of time or 2 years, this is a horizontal analysis, right? Again, sales going up is good, costs going up is bad, okay? And you would want to look at that. And because as a potential investor, okay, right now where we're at with Cara Foods, we've seen that the sales have gone up 68%, which is great. But we've also seen the cost percentage for our cost of inventory sold, which is a major cost for us, has also gone up quite a bit. What do you think as an investor? What are you leaning towards right now? Are you saying, what are you thinking? Would you invest? Would you not invest? Okay, so Young says never or no. Okay, right now at this point, right, we have a positive, right? We've seen sales go up, but we've also seen a cost increase quite a bit. We can't necessarily make a decision right now, okay? I mean, you could argue that this increase in your cost of goods sold might represent the inability of management to manage their resources, okay, which is kind of important in food service. But at this point, all we know is that sales have increased and one cost has increased. We have to look for a better picture or more information. We need to look at more cost percentages, okay? So I'm just going to share this again. There we go. So we looked at the cost of inventory sold. Great. What about the selling and general administrative expenses, right? What about the impairment of an asset or restructuring another, right? What about those looks to be only that looks to be the only costs, okay? But what about the others, right? We would want to see how the others are changing as well, okay? You'll also note here that despite a 67% increase in sales, if we look at the operating income here, our operating income only increased by roughly $26,000, okay? That's kind of a problem when your sales are increasing nearly $300,000. You really need to dive into your cost percentages and do a horizontal analysis here and make a judgment call as to whether the changes in the cost percentages are good or bad. And if they're really bad and you see a big change, you want to go looking for the reason why it changed so drastically. Okay? Before I continue, does anybody have any questions about horizontal analysis? Or maybe are you starting to see how these different kinds of analyses can help you understand more information about the financial statements? Are you starting to see that? Are you starting to see how this could apply to your final exam? Kind of quiet here. What do you think? Does it say why? Check it out. Uh, pew, 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 pew. Do, do, do. In this case, it doesn't, but also in this case, um, the cost of inventory sold includes other things. For example, direct labor, which would be salaries, direct product costs, and variable labor, including other fixed overhead costs and depreciation. Interesting. So not really. Um, so the question is, are you good folks starting to see how this could apply to your exam, right? Where you're being asked whether or not you would invest in Cara Foods. Okay, we've got some yeses, which is good. All right. So I'm going to share my files again. Maybe this is the part. I think that's right. Do, do, do. Okay. So I realized that was a lot, and maybe it's time to take a break because we're about to head into ratio analysis. Okay, so let's maybe take a 15-minute break just to kind of pump the brakes on the math a little bit, and before we move into more math. Okay, what do you guys think? Quick 15-minute break? Yeah. Okay, so we will take a break before we get into ratio analysis. So let's take a break, and let's be back at 2:08. Okay, and we'll start to calculate ratios. All right, everybody have a good break, and I'll see you in 15 minutes. Everybody, welcome back. I'm just putting up a poll here. Trying to taking a year or two. Here's a bit of a true and false. Trend percentage is calculated by taking year 2 figures, subtracting year 1, and then dividing by year 1. Yes or no? True or false? What do you think? I'll give you another minute on this one. All right, yeah. You all got it correct. Great. So yeah, the trend percentage is calculated by taking year's 2 figures, subtracting year 1, and dividing by year 1. Absolutely. I'm just going to put up another poll. A horizontal right. A horizontal analysis compares cost percentages from one time period to another. Okay, so I'll give you another minute here. It looks like most have answered, and yes, a horizontal analysis does compare cost percentages from one period to another. Absolutely. All right, good job, everybody. There we go. Okay, so now we're going to talk about ratio analysis. And a ratio analysis is calculating certain ratios that give an indication as to a business's strengths and weaknesses. Okay, and those strengths and weaknesses can fall into one of 4 categories. We calculate liquidity ratios, which give an indication to a business's ability to pay short-term financial obligations. There are solvency and leverage ratios, which give an indication to a business's ability to pay long-term financial obligations. There's profitability ratios, which give an indication to a business's ability to generate profit, right? And as actually, I'll talk about that in a second. And then there's operating performance ratios, which show essentially the performance of management or the ability of management to effectively manage the business. Okay. All of these kinds of ratios are important to an investor because the first two give an indication, generally speaking, to a business's ability to pay back debt and short-term costs. So this is essentially business health. And they would be interested in profitability because as a corporation generates profit, that profit technically goes towards the investor. So you'd be concerned, or you would want to know about the ability of a business to create profit because that's what you get for being an investor. And then operating performance. You want to know if the people that are managing the business, because you're technically the owner as the investor, you want to know if the management team is effective at running the business, right? So all of these ratios are important to you, and you would want to know them. You would want to see where the strengths of the businesses are, and if there are any weaknesses, how big are the weaknesses, and why are there weaknesses? The first kind of ratio that we're going to talk about is liquidity ratios. Okay, and again, liquidity ratios are the ability or show the ability of a business to meet its short-term obligations as they become due. Okay, there's two primary liquidity ratios that we will calculate. First is the current ratio, okay, which is a very rough measure of liquidity. Okay, so it gives you an indication as to whether or not a firm can pay their short-term financial obligations. And then there's the quick ratio, which ironically enough is not as quick as the current ratio, but it's a much better measure of liquidity because it only considers the most liquid assets. In both cases, when you're calculating them, you would want this ratio to be equal or greater than 1. Okay? Because if you calculate these ratios and they're 1 or above, it shows you that the business has the ability to pay all of their short-term financial obligations. Okay? And if it's above 1 or equal to and above 1, this would be considered to be a strength of the business. This is a good thing. The current ratio is calculated by taking current assets or total current assets and dividing by total current liabilities. So what I'd like you to do now is let's go look at Kara's 2017 balance sheet, okay? And in the chat, type in the value of Kara's total current assets and total current liabilities, and we're going to calculate the current ratio. So do that now, please. Okay, so we're looking at the balance sheet, and we're trying to find total current assets and total current liabilities. Yeah, exactly, for 2017. Okay. Sound good, Ryan? So everybody else, what have we got? Got to make sure we can find these things. So what are the total current assets for Cara Foods, and what are the total current liabilities? Exactly. So I'm going to put my whiteboard here, and we're going to calculate the current ratio. So the current ratio is calculated by taking current assets, or total current assets, divided by current liabilities. So in this case, our current assets are $137,856, and our total current liabilities are $157,608. So everybody put that into your calculator and tell me what you get. Yeah, I get roughly 0.87. Okay, now because 8.7 or 0.87, I should say, is less than 1, this would be bad. Okay, because the current ratio is less than 1. Because it's less than 1, it means that the total current assets, which are your most liquid assets, are less than your current liabilities, which are your short-term financial obligations. So you would question in your head whether or not Cara Foods can pay all of their short-term financial obligations because they don't have more than 100% in their current liabilities, or sorry, current assets. Okay. Good job, everybody. So I'm going to share my file again here. There we go. There we go. So we've calculated the current ratio. Great job, everybody. Now let's calculate our quick ratio. And we calculate our quick ratio by taking the business's cash, adding in marketable securities, if they have any. Okay, marketable securities are buying shares and bonds in other businesses. Some businesses do that, and some businesses don't. And then you add accounts receivable, okay, and divide again by current liabilities. Now, the reason we're only including these 3 accounts in the calculation is because these are considered the most liquid current assets. So these are the assets that could be liquidated super quickly and be used to pay the current liabilities. Okay. All of these accounts are again found on the balance sheet. Okay. So let's go back, and can somebody put the value of Cara's cash, marketable securities if they have any, and their accounts receivable in the chat for 2017? What are you finding? What is the value of their cash, marketable securities, and I'll give you a hint, I don't think they have any, and the accounts receivable. Would marketable securities have another name? I don't think so. Okay, so yeah, Mary Ellen's right for the most part. I think she missed a 4 in front of the cash. So we would calculate this by taking, let me just make sure I'm right. So nope, yeah, okay, so cash 41,971, 41,971, plus the accounts receivable, which were 60,991. There we go. And then we divide by our current liabilities again, which were 157,608. So what do we get here? What ratio what's the result? Absolutely, Vanessa. So if we put this into our calculator, what do we get? Yeah, I get the same thing. So in this case, the quick ratio is 0.65, which again is less than 1. So this is considered to be bad. Okay, you would be concerned here because the amount of cash Kara has and the accounts receivable that they have is 65% of their current liabilities. Okay, or the their short-term financial obligations. For now, I should put a little caveat in here, and I don't want to confuse anybody, but typically 1 equals 100%. Yes. No problem. Now, most industries, the equal to or greater than 1 is the rule, okay, across the board for most industries. In food service specifically, our kinds of businesses can survive on a current or quick ratio that is below 1. The reason for that, and we'll get much more into this in managerial accounting, the reason for this is because most of our costs are variable. And if most of our costs are variable, it creates a payable. And when you have more, when it increases the amount of your payables, it's technically increasing the amount of your current liabilities. Exactly. We do have debt, but we also have quite a few payables, right? So that's why our current and quick ratios appear so low. But for our purposes and your exam, please use the above or below 1 rule. Okay, we'll get much more specific and in depth around our industry when we get into managerial accounting. All right, good job, everybody. I'm just gonna share PowerPoint again. There we go. So again, both ratios should be equal to or greater than 1 to be considered good. Before I continue on to another liquidity ratio, does anybody have any questions about these two ratios? Okay, looking good, looking good. All right, onward. All right, so another liquidity ratio, and this particular ratio can be put into other categories. I put it into liquidity because it's easier to think about it that way. It's called days sales outstanding, okay, or DSO. And days sale outstanding is the number of days that a company takes to collect its credit sales or its accounts receivable. Okay. This is important. The accounts receivable turnover. No, Vanessa, I've changed it up and I've taken it out just because days sale outstanding is much more accurate, and it's much easier to interpret. Good question. So days sale outstanding and the number of days it takes your business to collect your receivables is important because that your receivables are cash that you haven't received yet, and your cash pays your expenses, right, or your bills. As an investor, you would want to know if a company collects their receivables in a reasonable amount of time, because receivables, most credit terms are net 30, so you have to pay your bills within 30 days. A good days sale outstanding is below 30 days. Okay. An okay days sale outstanding is below 40. Anything above 40, you would be concerned that the business isn't doing a very good job in collecting their sales, and that they will not be able to collect some of their sales. And how we calculate days sale outstanding is by taking our accounts receivable, and then we divide by our sales divided by 365. Okay. So let's go back to the financials here. Can you please find me the value of Kara's accounts receivable and the value of their gross sales? And throw it in the chat. So we're finding the accounts receivable for 2017, and we're finding the sales for 2017, or the gross sales. What do we find? So we're looking at total gross revenue for 2017 and the accounts receivable. Total gross revenue is on the income statement or statement of earnings, and the accounts receivable are on the balance sheet. What are we getting? And remember that we found both of these figures already. Exactly, Mary Ellen. The accounts receivable were $60,991. And Vanessa, the exact same. And the sales were, or the total gross sales were $775,241. So if we plug this in, so our accounts receivable, so $60,991 divided by sales, which were $775,241 divided by 365. Okay, and a little bit of when you're putting this in your calculator, you got to put in the brackets on the bottom. Let's put that in our calculator. And what do we get? Okay, 28. I'll wait for another response or two. Yeah. Yeah, so I get the same thing. I get around for the exam. Do you want us to show you the brackets? I would include them. Actually, if you're doing it on the computer, well, you're going to be doing it on the computer. You're going to have to include them in Excel. So, yes. So yeah, you're both right. I get roughly 28 or 28.71. Okay, and this is 28.71 days. So it takes Cara Foods 28, or I guess 28.71 days to collect their accounts receivable, which is sales that they've generated but have not received cash for, right? Because this is because it is lower than 30, this is good. Is it important to include the numbers after the decimals? Yeah, it is. But the whole number is also, as long as you had 28 here, it'd be fine. Yeah. Or if you were going to round, that's okay as well. So this is good because their days sale outstanding is below 30 days at 28.71 days. So this is good. So far with Cara, we've seen that their sales have increased huge using a trend analysis. We've seen some of their costs go up a lot as well, so that's a little concerning. We saw that their liquidity, their current and quick ratio were a little not that great because they were below 1. But their days sale outstanding is below 30, which is a good thing. So we're starting to kind of paint a picture of whether we would, whether Cara Foods is in a good position or in a bad position. Okay. So before I continue, does anybody have any questions about days sale outstanding? No. All right, I'm going to pull up the PDF. All right. So we're going to move on to the next category of ratios, which is solvency and leverage. Okay, and these ratios are viewed as an indication of the ability for business to meet its long-term financial obligations. Okay, so liquidity was the ability of a business to meet short-term financial obligations. Solvency and leverage, which are interchangeable terms, measure the ability of a business to meet its long-term financial obligations. The first solvency ratio that we're going to talk about is called debt to equity. Debt to equity is an expression of creditors' financing, or simply debt, in relation to the owner's equity or the owner's financing. Okay, we calculate this by taking total liabilities and dividing by total equity. Okay, and for a business to be healthy, we would want to see a debt to equity ratio of less than 2. Or sorry, less than 2, or less than 2. Yes. Yes, Vanessa. When they say a business is leveraged, it means they have high debt. So above 2 here, if you had a debt to equity above 2, you could say that the business is highly leveraged, or has more debt than equity, or a lot more debt than equity. If you're applying for a loan as a business, if you're applying for a loan to start up a business, the bank, in determining how much money they're going to lend you, they're going to calculate your debt to equity ratio based on how much equity you're bringing to the table. And they will never, ever, ever lend you more money. They would never, ever lend you more than 2 times the amount of equity that you're bringing into the business, because that gives you a debt to equity ratio of above 2, right? So everyone, go back to your Cara financials, and then in the chat, tell me the value of Cara's total liabilities and total equity for 2017. Okay, looks like Mary Ellen's got it. I'm just going to double check. Sometimes when I don't double check, I get it wrong. 736-607. Perfect. Yeah, absolutely. So our total liabilities were $736,119 divided by $607,420. So everybody put that into your calculator and tell me what you get. Yeah, Vanessa, I get 1.21. Okay, so this means that Cara Food has 1.21 times more debt than equity. It is good because it is less than 2, right? Again, we want to have a debt to equity ratio of equal to or less than 2. If you're above 2, it means the business is highly leveraged, and creditors and investors would be concerned about your business taking on more debt because you might not be able to pay the interest on it. Good job, everybody. We'll move on to the next one, which is related to interest. Here we go. So another solvency or leverage ratio is called interest coverage. And the interest coverage or interest multiple is a measure of the ability of a business to meet your annual or periodic interest costs. Yeah, Kay.
Question, what do you call it when the business has high debt? Is it high leverage?
Yes.
Great, thank you.
No problem. Or you could say that the business is highly leveraged. But again, you would only say that when you've got a debt to equity ratio of above 2. Absolutely. So the next ratio we're going to calculate is called interest coverage, and it showcases or measures the ability of a business's, it measures a business's ability to pay its interest expense as it becomes due. This is calculated by taking your operating income, or EBITDA, and dividing it by your interest expense for the same period. Okay? When your interest coverage ratio is less than 1.5, investors would worry that you don't have, or you might not be able to cover your interest in the future. As a creditor, if you had an interest coverage ratio of below 1.5 times, you would also be you would not give additional credit or a loan because you'd be concerned that the business won't be able to pay their interest on that new loan. Okay, so let's calculate that for Cara Foods. So everyone go find the operating income for 2017, which is on the income statement, and the interest expense for 2017, which is also on the income statement. All right, and when you find it, throw it in the chat. Operating income was 128. It was, yes. And the net interest expense was 12.45. Yes, absolutely, Mary Ellen. In fact, they were right below each other, which was kind of nice. Didn't have to go finding it. And if you had a hard time finding the interest expense, again, all you got to do is hit the Control F. You hit the Control F, type in interest expense, and then it'll bring you to wherever that pops up on the financial statement. Okay. So in this case, the operating income was 128,694 divided by the interest expense of $12,453. Okay. Were you able to find it now, Vanessa? It's right below your operating income. Oh, okay, I understand. Okay, well, it's here on the screen. So everyone, let's put this into our calculator, and what do we get? What is our interest coverage for 2017? Oh, you're pretty close, Soo Young. Found it, nice. Yeah, so we take $128,694 and we divide it by exactly, as Vanessa has mentioned, 12,453. And when we do the math, we get 10.33 times. So what this means is that Cara Foods' operating income can cover their interest expense 10.33 times. Because this is greater than 1.5, this is good. Because it's bigger than 1.5 times. This means that if a creditor is looking at giving more of a loan, right? They've got a debt to equity ratio below 2, which is great, and their operating income can pay their interest expense 10.33 times, right? So they are in a good debt position. They can get more debt if they need it, and they can pay for that debt, right? So this, as we start us here, our sales trend looks pretty good. Our horizontal analysis with our cost percentages was a little not that great. Our liquidity analysis was just okay. And our solvency or leverage analysis using debt to equity and our interest coverage is great, right? So we're starting to put this whole picture together about various aspects or strengths and weaknesses for Cara Foods. Right? Does anybody have any questions about interest coverage before I continue? Okay. All right. So I'm going to share my file here. Let's see where we're at. I think profitability is next. And it is. So profitability analysis or profitability ratios are measuring the ability of a business to generate earnings from available resources. There's two kinds of resources that a business can use to generate earnings or profit. One is equity, because we use equity in the business to invest into assets, and those assets create revenues and thus profit. But from an investor's perspective, it's the investor's money that is the equity. So it shows the ability of a business to take investors' money and create a return from it. Okay. The other resource that a business has to create earnings are your assets. Your assets are the things the business uses on a daily basis to create revenues and thus profit. Both of these ratios show how good the business is at either using investors' money or using assets properly. Return on equity is calculated by taking the net income for the period and dividing it by shareholders' equity. In this case, the higher the ratio, the better. Okay, if it's between 10 to 12%, it's an okay ratio. If it's between 12 to 15%, that's great or good. Your return on assets, on the other hand, is similar in that it's your net income divided by total assets, and you would want to have a higher ratio, or the higher the better, just like your return on equity. And this particular ratio, your return on assets, is used more as a comparative measure. So you would compare to a similar style business to decide whether or not it's good or bad. Or you could use it as a comparative metric between 2 years in the same business, so year over year. So, good folks, could we please look at Kara's financials and find the net income for 2017, as well as total equity and total assets, and put that in the chat for me, please. And on the financial statements for Kara, it's not called net income, it's called net earnings on the income statement. What was the net earnings, the total equity, and total assets for 2017? I think Ryan's got it for the net income or the net earnings. Let me double check. Yep, I get 109,808. 109,808. Awesome, Ryan. Thank you. Excuse me. And yeah, Maryland's got the others. So the equity, the total equity on the balance sheet was $607,420, and the total assets were $137,856. Just Oh. The assets. So we're looking at the total assets. Looks like you had the total current assets. So I'm just going to throw that in here. Maybe I'm wrong, actually. Hold on. There we go. So, yeah. So you want the total assets. Oh, sorry. Do we have the same thing? Okay. Sorry, I even got confused. So yeah. So our net income or our net earnings for the period was 109,000. Exactly, Vanessa, $808 divided by total equity of $607,420. So if we do the math here, what do we get? What's our return on equity? What do we get? $109,808 divided by $607,420. Okay, yeah, I get 18%, 0.818, which is 18%, which is greater than 15%. So this is great. So what this means is that Cara Food takes shareholders' money and creates a 15% return for their shareholders. So if you invested in the business, this is good because it's showing that they're taking the money that you're investing in the business and creating a 15% return for your money. It's not necessarily what you get paid as a shareholder, but this is their ability to generate earnings using your money. Does anybody have any questions on ROE or return on equity before we go to return on assets? See, I'm better than your stock? Better than my stock too. Much better than my stock right now. All right, so now we'll do ROE. So ROA. So ROA, so return on assets. And yeah, Marianne, if I knew then what I know now, I'd be very rich. Return on assets is calculated by taking your net income, again, or your net earnings, and dividing it, this time instead of equity, you divide it by your total assets. All right, so what do we get here for our ROA? I believe we had our net earnings of 109,808. Here we go, divided by $1,343,539. So everybody put that into your calculator and let's see what we get. Yeah, exactly. I get 0.08 or 8%, right? So what this means is that the company or the management in the company manages their assets in a way that produces an 8% return on those assets. So this is how many assets we have in the business, and this amount of assets is generating 8%, or we're getting an 8% return on our assets. Okay. Again, this is used as a good comparative, so you could compare this figure to another business or even to 2016 to see if it increased, right? You want to see an increase in your ROA and your ROEs. Good. Does anybody have any questions about return on assets before we continue? No. Really good job, everybody. Vanessa, yeah, if you're going to calculate this one, I would definitely compare to 2016. But in your exam, it's going to be different times, like different years, I should say. Continuing here. Okay. So now it's 3:05. My throat's starting to get a little bit raspy, so I'm going to grab a drink of water. What do you say we take a quick 10-minute break? Yeah? All right. We've got roughly 10 slides to get through here, so let's take a quick 10-minute break, and let's be back. We'll call it at 3:16. Okay? So everybody have a good break. Good job, and I'll see you in 10 minutes. All right, welcome back, everybody. Hope everyone had a good break. So, thankfully, at this point in our class, a lot of the hard math and calculations are already done. I'm not sure the math in the previous slides was terribly difficult, but being exposed to the new equations, I can appreciate might be a little mind-blowing. The rest of the ratios that we're going to be calculating, you likely already have done before. And if you've completed a trend analysis, sorry, not a trend analysis, a vertical and horizontal analysis, you've already calculated all of these things. For example, your profit margin is your net income divided by total sales. This, if you've done a vertical and horizontal analysis, you've already calculated your profit margin, okay? It's just your profit as a percentage of your sales, right? In the horizontal analysis, we look at the change from year over year to understand whether our profit is going up or down. But generally speaking, as potential shareholders, we'd like profit margin to be the higher the better. Okay, but we definitely want to look at it comparatively year over year. If we've done in a similar fashion, if we've already done a vertical and horizontal analysis, we've already calculated our operating efficiency ratio, which is the operating income divided by total sales. And again, just like your profit margin, the higher the better. And this gives an indication of management's ability to manage operational costs or generate profit by controlling operational costs. So you've already done these before in doing your horizontal and vertical analysis. So here are some measures for investors. Some are likely already going to be calculated for you, okay? And most of these measures are good for comparative purposes, okay? First is the earnings per share, which is a reflection of management's ability to achieve earnings for shareholders, which are owners of a corporation. We calculate this by taking net income, minusing preferred dividends, and then dividing it by the number of outstanding shares. Now, I wouldn't be too worried about being able to calculate this because it's always given to you on the financial report. Just let me make sure I'm not putting my foot in my mouth here. So go to your Cara financial statement, hit Control F, and in the search bar, type in EPS, which stands for earnings per share. And then tell me what the basic earnings per share for 2017 was in the chat. So go to your Cara financial statements, hit Control F, and then type in EPS, which stands for earnings per share. What do you get? Yes, Vanessa, absolutely. So I apologize, the basic earnings per share. Exactly, 1.84. And just like Kitsat has done, you can also see the earnings per share for 2016. You can use the earnings per share as a comparative metric year over year. So what's happening to the EPS or the basic EPS from from 2016 to 2017? Is it going up or is it going down? Exactly, it's going up. And exactly up. So because this is going up, or the earnings per share is going up, this is great, because the earnings per share, or the earning per share, is your money as a potential investor. So it's a great comparative metric year over year. You can also compare it to similar style companies, but we're not going to do that here. Next is our price earnings ratio, which can be kind of confusing. It gives an indication of the investing public's willingness to invest a certain amount of money for $1 of earnings. Does it mean the business has more investment? No, Vanessa. The increase you're seeing is that the investors are getting more earnings for every share they own. Yes. So this is why it's good for investors. No problem. So the price earnings ratio is, again, a good comparative metric. We like to see it as high as a business. You like to see it as high as possible. And again, it's the amount of money the public is willing to spend on $1 of earnings. So again, year over year, if this is increasing, this is good, because it's showing the public is more willing, or is willing to spend more for $1 of earning in the company. And we calculate this by taking the current market value per share, or the current share price or stock price, and dividing it by the EPS, or the earnings per share. We'll continue here. Next is called the dividends yield, and it relates the current price of a business's common stock to the annual dividend. Okay, so it kind of the dividend yield is essentially your return percentage. Okay, and how we calculate that is the annual dividends per share divided by the share price. This gives you the return on investment that you get for owning one share in the company, right? For example, let's say the annual dividends. Let's say the annual dividends were $15. And the share price was $55. Vanessa's question on the previous slide, we don't need to worry about the calculations. No, not really, Vanessa, because it's already presented. Exactly. Exactly, good point. How can we find the market value per share? You go online, go onto Google, and then type in the company's name and then share price, and it'll usually bring up the current share price. So here, let's calculate our dividend yield. Okay, which again, no problem at all, is the annual dividends per share, I should say, divided by the price per share, or the share price. So in this case, it would be $15, which is the amount of the dividends, divided by $55. What do you get? The dividend is $15, and I'm not getting this information off of the financial statements. It's just information I'm presenting. It's just an example. Okay, 27%. What are other people getting? 15 divided by 55. Yeah, I get what Quetzalcoatl got. I got 0.27. There we are, or 27%. Okay, so this is essentially your return. You're getting a 27% return on owning shares in our example here, I should say. Now, this is good as a comparative metric across similar businesses, but also the stock market return, the average return for the stock market bounces around a little bit, but it's around 10%. Okay, because our dividend yield is greater than the average on the stock market. This is a good thing. We're getting our return that we're getting in this example is much higher than the average return on the stock market. So this is a good thing. However, I would put a little caveat in here, or a disclaimer. Businesses or corporations don't always pay out dividends. Okay, there's two things they can do with their dividends. One is retain them in their business, or two, declare dividends and actually pay out dividends to shareholders. You can't necessarily calculate your dividend yield if they did not pay out dividends in that year. Okay. Does anybody have any questions about dividend yield before we continue? Yes, Vanessa, for corporations, absolutely. Problem. All right, let us continue. Here are more things that we've already calculated. Okay, don't worry about your inventory turnover, because Cara Foods they lump way too much stuff into their inventories, if you will. So you don't need to calculate that for your exam. Okay. We have our average guest check, which is the average amount of money a guest spends in your restaurant or in the food service business. This is calculated by taking total sales and dividing by total guests. 9 times out of 10, for restaurant-style corporations, this is given to you in the body of the financial report. So you probably won't need to calculate this. And then cost percentages, again, give an indication of management's ability to control costs. And if we've done our vertical and horizontal analysis, then we've already calculated and compared our cost percentages. So we're pretty much already done these as well. We're not going to talk about the cash flow analysis because you won't be able to do it very well until managerial accounting. So don't worry about your cash flow analysis. So at this point, we've looked at a bunch of different ratios, right? We've looked at, we've looked at a trend analysis, vertical and horizontal, and we've looked at a ratio analysis. If you do all of those things on your exam and you do them right, you will have enough information to start to build an opinion as to whether or not you would invest in Cara Foods, okay? And the justification for whether you would invest or not is, of course, the result or the information that the ratios are telling you. However, there, as we've noticed, there is much more information contained on financial statements other than the financials themselves, like the numbers. We have the auditor's opinion, and we also have notes to the financial statements. I think in this case, you won't be worried too much about the auditor's opinion. Okay. You will, however, want to review some of the notes to the financial statements. Remember when I was saying, you want to go find out the why something looks bad, right? Or if you calculate debt to equity and it comes out really bad, above 2, you would want to go find out why, and how you do that is through the notes of the financial statements. The numbers will tell you a story about the business, okay, so strengths and weaknesses through various analyses. The notes to the financial statements tell you a story as to why the numbers are the way they are, okay? And then a lot of times, there are things hidden in those notes that you need to know about, okay? Does anybody remember, by chance, think back to the beginning of the semester when we were talking about your exam, okay? I forget, it was probably the first or the second class that we had. There was a tip that I had you star in your notes. Does anybody remember that? No? Okay. No? Okay. Must record descriptions. No, Ryan's got it, actually. Cara Foods bought the keg. Okay. If you haven't written that down yet, do it. Okay. The financials notes are going to tell you a lot about the keg. Okay. And that is something you need to be aware of when you're completing your exam. Okay, so a little tip there for you. And that's all contained in the notes. Because I told you not to worry about that, we're going to skip this. We're also going to skip this. So some limitation to financial statements, okay? Financial statements are numbers, right? They're going to tell you a lot about a business, but you really need to read some of the notes as well, okay? You need to understand how those notes, or what the notes say in some cases, affect the numbers that you're seeing, right? For example, what would be an example here? If you saw your debt to equity ratio jump up from one year to another, right? So when we're calculating our ratios, it's good to calculate them for both years on the financial statements so we can see how they changed over time. If you've seen that your debt to equity ratio jumped or increased a lot from one year to another, you would want to know why, but the numbers itself do not tell you that. So you need to go look at the notes so that you can create the big picture, if you will, or the whole story. And then lastly, qualitative concerns, okay? All of the things that we were looking at, all those ratios and all those lovely things, those were all numbers. Those were all finance. Okay, there are other ways that we can understand business performance from a potential investor. Has anyone heard of the triple bottom line before? Okay. In accounting or in business, profit is called the bottom line. The reason we call it the bottom line is it's because it's the bottom line on an income statement, and it is the golden standard of business performance. Okay, The triple bottom line, on the other hand, adds two more measures for performance. Okay? Profit is the economic performance of a business. Okay? It's easily measurable because it's in numbers, and thus we can compare that in a lot of cases. However, there are two other bottom lines that we have. Okay? We have a social bottom line and an environmental bottom line. Our societal bottom line, it measures how well our performance is within society, or creating value for society. Our environmental performance is how good we are, or how our performance is within the environment, or the environmental realm, if you will. Both of these bottom lines are very hard to calculate, and in fact, the scholars still don't know how to calculate the social and environmental bottom line using numbers. However, you can use a little bit of research and the financial notes on financial statements and ask yourself, how well is this company doing or performing with respect to society and the environment? The triple bottom line essentially measures sustainability, okay, or the ability of a business to be sustainable. I'm quite sure this is a term that you haven't heard before. Anyone understand? Does anyone heard of sustainability before? Sustainability. Yeah, it's an important thing right now. And a lot of businesses in the beginning, when sustainability wasn't as much of a trend or as common practice as it is now, the reason why people or businesses were not very sustainable and only focused on their economic or financial bottom line was because social and environmental performance were extremely hard to calculate. And because it was hard to calculate, they found, or they thought, that investing into societal programs, environmental programs, reducing wastage, things like that, they thought that that investment would only come out as a loss because they couldn't calculate profit based on it. However, the past has shown us that to forget or to neglect your social and environmental bottom line has a drastic effect on your environmental bottom line. Yeah, Vanessa. Yeah, you should be taking into consideration the social and environmental initiatives for Care Foods. Absolutely, because if you neglect those two bottom lines, it often affects, and the research has shown that it affects your financial bottom line. Right? I have some examples on the next slide. All right. So here's some examples. Right? Nike. Obviously, we all know who Nike is. They make shoes and sporting equipment and sporting clothes. They make a lot of money. They do fairly well for themselves. In the 1990s, they were marketing and advertising running shoes for women, and the marketing campaign was, empower yourself, be the change you want to be a strong woman, take charge, things like that, right? Well, it just so happened that those shoes that they were marketing towards women, empowering women and things like that, those shoes were actually made in a female sweatshop with female sweatshop labor. How do you think this affected the perception of women pretty much everywhere? Or even men? Exactly. This was not good. Nike neglected their social bottom line. It is contradictory. it neglected their social bottom line, and it affected their sales drastically. Women no longer were buying Nike shoes because they obviously didn't stand for women's rights, empowering women, all the things that they said they were doing. So it affected their financial bottom line, right? As an investor, would you invest if this just happened to Nike? No, you wouldn't. Likely, and very likely, I don't know what the price was then, but the price when this happened, price per share probably tanked huge because this was awful news, right? What about Moxie's, right? In 2017, they moved their beef purchases from Canada to the U.S., and it was based on a stupid little loophole. Okay, how do you think the Canadian consumer reacted? And also keep in mind that Moxie's in the past has advertised very heavily that they use Canadian beef. Same way they did with Heinz. Exactly. Not so great. This was not good social performance on behalf of Moxie's, and it negatively affected their financial bottom line. Exactly, Vanessa. And then what about Volkswagen in 2017? There was the emissions scandal, right? The Volkswagen cars were putting out more emissions into the environment than they were allowed to, and they were lying about it. How do you think that affected the sales of those cars in that following year? Nobody's going to buy them because they're not environmentally friendly, and because Volkswagen lied about it. So all of these businesses neglected either their environmental or their social bottom line, which is a reflection of social or environmental performance, and it's had a negative effect on their financial performance. Customers stopped buying their products. People didn't invest in their business. So you, as an investor, want to know how a business is doing with respect to their environmental and their social bottom line. Well, because if they're doing well, then that's great, and that's going to protect their financial bottom line or profit. But also, if they're not doing well, then this could negatively affect their profit. Ariane, I remember when Maple Leaf had to recall a whole bunch of food products due to contamination, but they were okay because they were upfront and honest about it. Yeah, exactly. Yeah. What's another one right now that that wasn't too hot? I don't know. I want to say something about Uber Eats, but I don't know. I don't know if that's going to affect their bottom line because they are kind of like an essential service. Your grandmother refused to buy another products. Absolutely. Right? So social and environmental performance does have an impact on financial performance, so much so that it's not it's so much so that it's becoming a popular investment strategy. Investors are now investing their money into sustainable businesses because the justification is that those businesses are going to last long term. Airbnb is not so hot among travelers anymore. I guess, yeah, not so much so. And yeah, I don't know. So you have to know a little bit about their environmental and social bottom lines. We've already done these. And we've already talked about the final exam. Exactly, Vanessa. Sustainability and social responsibility, or corporate social responsibility and corporate social performance, are big things right now. And it's crazy to read about it because these ideas or these theories have been around since like 1970s. It is appealing to investors. And only now is sustainability and corporate social performance starting to become really important, right? If any of you, what is it called? If any of you are interested in reading more about corporate business ethics or sustainability, corporate social performance, Ed Freeman, who coined stakeholder theory. Okay, which really he brought up the notion that it's a business's stakeholders are just as important as a business's shareholders, and it really paved the way for sustainability as well as corporate social performance. Another cool author that and Ed Freeman writes in a really cool way. Another awesome author around corporate social performance was Donna Woods. Her 1990 work on corporate social performance, and it's a corporate social performance model, shows businesses how they can be socially responsible. So it was really enlightening for me. And yeah, so we want to look at all of these things when we're doing our exam to provide the justification as to why or why not we would invest into Cara Foods. Okay. So yeah, actually we're done a little bit early today, which is great. Anybody have any questions, comments, concerns before we conclude? And as soon as this video is done converting, I'll post this to Blackboard just in case you want to review this again. Yes, Vanessa, absolutely. Definitely do external research to help with that component of the exam. Yeah. All right. And everybody remember that I'm holding additional office hours on Monday from 2:30 to 3:30, just in case you have any questions about ratios, your final exam, things like that. I will also have office hours on Tuesday and Thursday from 1 till 4 for the same reason. These are completely optional. They're drop-in. You don't have to let me know you're coming. If you have some questions, come by. If you don't have any questions, perfectly good too. You don't have to come whatsoever. Right? All right. So if there are no other questions, we will conclude here, which is great because we have a faculty meeting at 4 o'clock, so in about 10 minutes. We're going to be talking about the information technology systems and whatever happened. I have no idea. I'm not a techie dude. So if there's any major changes coming up, and I don't think there is, I'll keep you in the loop. Okay. If you don't hear from me, then probably nothing has changed. Okay. All right. So everyone have a great rest of your day, and good luck on your exam. Good job with the course. Everyone did really well. Okay, following along, things like that. Remember to submit your assignment number 2 this Sunday by midnight. And congratulations on making it through the content of Fundamentals of Accounting. All right? So have a great rest of your day. If I don't talk to you, have a great weekend, and see you during office hours if you need it. All right? Have a great day, everybody. And that's a good point, Marilyn. Yes, I will likely have your participation marks up on Sunday before the end of the day.